Good morning, everybody. Welcome back. Happy Monday. And, typically markets during the summer are very quiet. There's a nursery rhyme in the industry that is sell in May and go away. And typically it's because there's less action. Large money managers taking aggressive positions are on vacation. They're taking some time off in the summer. Everyone is simply looking inward, right, at their own time. Europe is also closed. They close offices for entire months and that type of thing. And so it is a time for kind of strategic pushes if you want to do it. So if you're a company that's behind, if you're a fund that's sort of behind or under the ball, it is an opportune time to sort of like buckle down and move more aggressively where the rest of the world is caught a little bit flat-footed because it's summertime, right? And I think governments also take advantage of this, particularly when they're viewing their economies and their people from that top-down basis. And so that's why today I'm going to talk a little bit macro, but I'm going to talk about it in a way that without getting terribly into the weeds. And we're going to start off with I want to start off, of course, with kind of the case for Japan. But let's jump into Ray Dalio and Jamie Dimon on the U.S. economy because I think it lays a really nice framework for what I'm trying to iterate here. So, U.S. I don't know if you're on Twitter, Ray Dalio, Jamie Dimon. They've been a couple of viral clips that I actually think at least one of them is a little bit old. I don't think either of these clips are very recent. It's also not anything new that either of these individuals have said. Who's Ray Dalio? Who's Jamie Dimon? Ray Dalio is one of the most successful hedge fund managers of all time. He's the founder of Bridgewater, a oddball hedge fund in Connecticut that does intense personality testing for recruitment. On the other hand, we have Jamie Dimon, who's the CEO of JP Morgan. He's been the CEO for quite some time. And these two figures are part of, I think, like the triangle of American kind of trust in free markets and in capitalists for the sake of capitalism. So, and I would add Warren Buffett there. So I think Dalio, Dimon, Buffett, they represent each a corner of, and maybe we have George Soros in the sort of XY grid of chaotic evil, whereas Warren Buffett would be like. Would be neutral good or righteous good or however you want to set up that graph. So both of these people, their statements recently have been going pretty viral, I think, on social media, where they basically pound the table and they say, the United States is the most fortunate and successful country of all time. We have a rip-roaring economy. We have a powerful military. We have unlimited access to energy with the sort of land that the United States has, the access to hydroelectric power through various rivers and dam systems, the access to oil, the access to extremely advantageous global ports. And this is unbelievably true, especially when you are kind of a top-down analyst. You start in the biggest swaths. It's like, okay, there is one planet, right? There are X amount of countries. Which of the countries have the most power, or the most assets, the most access? And certainly Ray Dalio is notorious for sort of macro investing and macro thinking. Jamie Dimon is the CEO of one of the most important banks in the world and certainly in the country. So he has to be a macro thinker. He has to spend a great amount of time. So both of their statements, to summarize, paraphrase a bit, were along those lines. We have an unbelievable economy. We have unbelievable natural resources, unbelievable strategically significant natural features, in terms of the geography of the U.S. and how that's advantageous, surrounded by two oceans, has mountain ranges, has raw materials, so on and so forth. And when you really start, right, that macro analysis where you start at the very highest level, who are the countries that own the most and have the sort of greatest outlook for the future, you kind of stop short when you go and you look at the United States. It's a screeching halt. I mean, you immediately realize that this country is an absolute juggernaut of an economy, and especially having grown up in a family that's not from here and having connections to my family and friends in Latin America and Europe, etc., you notice that the wealth there is unbelievably concentrated and nominally small. There are only very small few. There are a small amount of wealth owners, and they're extremely sophisticated, and have some sort of either unfair advantage or extreme legacy advantage, where simply they have a knowledge retention on an industry in the country that they completely own through their family or through their network. In the case of the United States, you could meet Bob Smith at a diner on the side of the highway. He may look maybe like a truck driver. He may look like a fancy pants tie bar wearing kind of guy, but he could have $10 million in his checking account. This country is just so massive, so productive. It has seen an extremely limited amount of recessions or economic fallback since 2008. So I think the case for Ray Dalio and Jamie Dimon completely still holds, and it echoes something that I've repeated many times on these chats, that the U.S. is the least dirty shirt. We could all be very worried about economic drawbacks or global war or any of the above that may kind of make us feel a little bit more bearish, a little bit more concerned about the future, especially our investing future. But I'd like to echo that sentiment that this is certainly the least dirty shirt, and the advantages that are captured by the country are unbelievable. On the flip side of that, it's been interesting. This may have crossed also on socials. I know that my socials are probably a little bit biased and focused here, but it was Janet Yellen, head of the Treasury, going over to China, and there's clips of Janet Yellen bowing profusely at Xi Jinping, and Xi Jinping like not bowing back, and so the internet's going kind of wild. Alt-right Twitter is going pretty haywire on that one. I'll equate it to the what's his name, Hunter Biden. There's a clip of Hunter Biden like wiping his nose on a balcony event behind Joe Biden and Jill Biden, and alt-right Twitter and schizo Twitter are going crazy, being like, he's doing cocaine. It's like, come on, guys. This guy, I don't have any love for almost anyone in Washington, D.C., and I try to keep things as apolitical as possible here. But there's just no chance that guy is doing that in public in front of the president, on the balcony. Like, let's try to be a little bit reasonable. And don't get me wrong, I love a good conspiracy theory. So yeah, Ray Dalio and Jamie Dimon, I think on the macro front, are spot on. It's just a matter of when are you, investing in the U.S., because there is volatility. There has been volatility. There will be more volatility, especially as U.S. hegemony across industry, banking, military, kind of stutter steps, because we'll see that there are growing powers. And a big part of the Janet Yellen trip, where she profusely bowed at Xi Jinping and made Twitter mad, U.S. Twitter, was basically a communique about, hey, we want to continue to be economic partners. We're not looking to stamp out China's economy. And this leads me to the case to Japan. So the case for Japan, I have had an interesting bias over the course of my career for two countries outside of the U.S. that I have both, had a lot of wins, had a lot of good calls, brought forth some really good ideas, but especially Japan has been like a source of just non-performance for me. It hasn't really been a source of loss. I've never, come up with a report or a recommendation or something like that on a Japanese company and like truly, been wiped out at all. But it's certainly been unbelievably lackluster. It's been pieces of portfolios and strategies I've designed that, it has been the sleepiest part in, I'd say, over the past 5 or 6 years. And I'm extremely bullish on companies like Nintendo. I mean, there's a lot to love in Japan. Things were very cheap for a very long time, if we're talking like public companies. But the case for Japan is predicated on the case for China. So I'll share some articles today. Alexander, our intern, will be sharing across the Newswire channel. So check that out. That's kind of going to be like our flow of just info and news that's crossing our desk that we think is interesting. And it's predicated on China. So China is basically a funny like 6 to 12 months cycle ahead, I would say, since COVID, and because of their deviation, both in like COVID policy and in financial policy and fiscal and monetary policy. They've been bogged down by a few things. I mentioned this before. One was COVID, the sort of methodology they chose to go about trying to restrict COVID spread. Second was a little bit of the economic purges, I'll call them. So the Chinese government went and severely audited a lot of lenders, a lot of real estate firms. They really took over and tried to understand technology companies, shutting a lot of them down. The big news in recent history has been Ant Financial, how Ant Financial basically got taken over, shut down. The CEO, why am I blank? Jack Ma was like sequestered, and no one knew where he was for days, and there's a lot of speculation around that. I think the footnote to this entire thought is don't invest in communist countries. It's pretty much I would say Wall Street is divided into two camps, and one is that camp, don't invest in the communist countries, and the other is, well, they're in the market and there's good returns, and that's very true. I mean, some people are unbelievable at trading China. I've tried my hand a couple of times, but so many people have like wagged their finger at me and be like, don't invest in communist countries, when they can flip the script on you and completely wipe you out. So they went through a little bit of a corporate purge in China, after COVID or during COVID. And then it's been a continuing lackluster performance economically. I mean, their economic growth slowed down significantly. Politically, they tightened on their businesses. That sent a signal to investors abroad, hey, maybe we don't launch that project in China, maybe we do something else. And that has led us to where we are now, where unlike the rest of the world, where here in the States, the Federal Reserve keeps raising interest rates, they want to basically break the economy. I mean, they don't want to break the economy, they want to break the economy, like slow it down, slow people's consumption, and slow down the price increases that come with inflation. So everyone's very eager for the latest inflation reading, and we'll digest and of course give you an update. I feel like I love to talk about it, but I'm not sure if you guys like to hear about it. So the case for Japan is predicated on all of that nastiness that's gone on in China, and we have seen this, right? Apple is funny because Apple is behaviorally a leader, but I would say product development wise, they're a follower. Behaviorally, they prioritize and they solve the most important problems first. And I remember during like peak COVID, I kind of identified a correlation between what Apple was doing and then what the government was doing. And Apple was very interestingly kind of a leading indicator for a lot of policy. We can dive into that at another time. But Apple was also one of the first companies to make massive moves out of China into places like India, into places like Vietnam, among others, and they manufacture a lot of components, or they buy components from South Korea as well. But the core manufacturing piece was in China, and now they've been moving sources out to India. And so Apple's a leader. I imagine a lot of manufacturers, a lot of maybe high tech, high quality, perhaps maybe even national security company that has a national security side to why it may want to manufacture outside of China. Things like computers or processors or anything that can like store, transfer information or collect information. That may be changing. And so China's in a tough economic position. Large clients are moving out of the country. China has really ramped up its sophistication in manufacturing. So, saying that something is bad because it's made in China is certainly not true today. I speak from experience across a couple of different kind of worlds that I've dipped my toe into. Some of it textile, some of it electronic, and they make great stuff. They can, if you're willing to like pay the price and find the right people. And I think that those are challenges for companies like Apple that have sort of helped develop these methodologies. And I'm running over, but essentially the case for the Japan is based on a slowdown in China and an outflow of business. Right now it's going to India. I think Japan will absorb a great deal of the higher end manufacturing stuff, specialty manufacturing, as they always have. But I think that there is a stronger case there, since there's not just an economic reason to do so, but also political reasons. So it's a little bit interesting to think about that, especially given Janet Yellen's recent trip to China to visit Xi Jinping, which is a little bit of a political kowtow in some respect, while our businesses are leaving the country. So it may be, a little bit of a damage control trip. We'll see what the reports are from those meetings in the coming days. And then last but not least, we basically covered it in our comments today, but higher for longer. This is something that you're going to see more of in the financial press. It's been a little bit of the contrarian case for the last year and change. I have certainly identified with this, and it's the notion that interest rates will remain higher for longer because we're not seeing the economic behavior that the Fed wants to see. People are the economy is still strong, job market is still strong, earnings reports on companies are still strong. And so, the belief, there's like three camps. There's a camp that believes the Fed will raise interest rates and they'll come back down very quickly, problem solved. There's the camp that this won't work how it's going. The Fed will raise interest rates extremely aggressively as they have in the past. Take a peek at the 80s, 70s, 80s. And then there's this camp, the higher for longer, that thinks that, well, this will work, but it will have to deal with the third dimension, which is time, or the fourth dimension, I suppose. But in terms of money, it's just time, because people, for some reason, seem to think that the time frame we've been given makes sense, which is like 1 to 2 years. But I believe that it will be a little bit more of a drone, and we'll have interest rates higher for longer. And it'll put kind of this numb pressure on the U.S. economy. So that's it for today, guys. Feel free to hang out in the Discord, ask questions, book a session with me. We'll be on the Newswire sharing some stuff, some charts. And have a great week. Have a great day. We'll catch up on Wednesday. Goodbye, everyone.